Well, good morning, everybody, and welcome to my webinar. As we do every week, we'll be updating you on the mortgage market today and kind of what is happening, what is changing, and how we can keep you abreast in advising your buyers and sellers as we navigate these crazy, crazy times. So let's go ahead and dive in. First of all, I want to welcome Jeff Lee back in today. Jeff, are you with us? Jeff seemed to have disappeared. All right. Well, we'll catch Jeff in a little bit, but I want to go ahead and get started here. So let's take it away. So what am I going to talk about today? So shocker, we're going to cover a rate update. We're going to talk about forbearance and what's been happening with forbearance. We're going to go through some down payment assistance rule changes. And you're going to say, John, why are you talking about down payment assistance? Well, I'll share a little bit with you, but the bottom line is they're still suspended right now. I don't want you to think that they're back up and running, but the rules are still out there and I want you to be abreast of them because we're hopeful that we're going to have down payment assistance back reasonably soon, and we'll see. We're going to talk about guideline updates. And I'm going to go through a Q&A, and that's really the meat of what I want to cover today. Is there's a lot of changes that have been happening, and we need some clarification on it. And so I want to go through very, very specifically how those changes are going to impact your buyers and sellers as they go on to buy something else. So let's go ahead and get started. So first and foremost, interest rate update. It has been stable for the last 45 days. So we see that the interest rates have not been moving very much. Guys, that's no new news. That's the same thing we've been talking about for the last month and a half. We haven't seen big changes. That's a good sign because the volatility that we saw previously, that is a bad sign. We don't want to see these rates shooting up and down like this because remember, down is bad for interest rates. That causes rates to go up. And so when we have interest rates that are up on this chart, that's a good thing, and we're seeing some stability. We're still not seeing rates anywhere near as low as they should be. The difference between what the Federal Reserve is paying for mortgages and what mortgage companies are charging for mortgages is bigger than it's been in a really, really long time. We're hopeful that's going to continue to shrink as we get more stability. So our advice has not changed. We expect rates to stay low at least through the end of the year. And now is the perfect time for somebody who's buying a home, unless they're paying cash, buy a home when rates are super low because that's the biggest determining factor to your monthly payment. If you're purchasing a home, lock immediately. But if you're refinancing, as long as today's numbers make sense, we expect rates to be the same or lower once we're done with the loan process. So if you're refinancing, it does not benefit you to pay a higher interest rate to freeze the rate for a long period of time. So that's something super important to remember as you've got clients, maybe they've got mortgage insurance from a loan they did a couple of years ago. Maybe they're looking to pull some cash out. We're relaxing some of the cash out guidelines. So just be aware of the fact that when we're talking about refinancing, we're still in a position that it doesn't make sense to lock in the interest rate in the beginning of the refinance process because we expect it to stay the same or even potentially get a little bit better by the time we're ready to lock. All right, that's enough on interest rates. Now let's dive in real quick on a forbearance update. Here's where we're at in the forbearance world. We continue to see forbearance numbers go up. So this top line is the total number of people that are in forbearance. That number has continued to inch up, but the rate of increase has decreased. I think that's calculus. I think I took a year or two of that. So basically, what is that, right? Calculus is the rate of change over time. I don't know. Anyway, good thing I don't have to deal with calculus. So we're not seeing as many people go into forbearance as the last month has gone by. We've seen fewer and fewer people adding to the numbers of people going into forbearance, but we're still seeing the numbers go up. So there are continuing to be people who are going into forbearance. Fannie Mae and Freddie Mac have the highest number of people in forbearance, but as a percentage, FHA and VA are the hands down winners because FHA and VA have fewer mortgages outstanding. And therefore, even though fewer of their clients are in forbearance, it's a greater percentage of the pool of homeowners that have FHA and VA loans. All right, so not a whole lot to talk about on forbearance today, but a couple of interesting facts. There was a couple of articles that came out last week that there were some surveys that were done of people who were in forbearance. And the specific questions had to do with how badly did you need a forbearance? And what they came up with is that only 5% of the people that filed forbearance said they could not have made their mortgage payment and that they had to file forbearance. Now, I know some of you aren't math majors, so I'll do the math for you. That means 95% of the people could afford to make the monthly payment, and they went ahead and filed forbearance. Now, there's a skewed portion of this. The next bullet point talks about 26.2% of the people could have paid, but they would have had to skip paying other bills. And so I understand those people obviously, so that's basically a third, let's round up and call it 33% of the people in forbearance either could not have made the payment, or they could have, but they would have had to skip a bunch of other bills. That means 2/3 of the people went into forbearance that didn't have a need to be in forbearance. And as a matter of fact, 21% of the people that are in forbearance made their May mortgage payment. So you've got essentially, and I'm rounding a bit here, you've got a third of the people that had to go in forbearance so they would have missed some bills. You've got a third of the people that went into forbearance and they didn't need to, but they went ahead and kept paying their mortgage payment. And then you've got another third of the people who went into forbearance, didn't need to be in forbearance, but went ahead and skipped that monthly payment. Again, I'm skewing the numbers here, but that really gives you a definition of the three different camps that we're dealing with. And it is definitely skewed by age demographic. I couldn't find the article that I saw last week, but it talked about millennials, Gen Xers being more likely to file for forbearance that didn't need it, versus your baby boomers who, hey, they're on a fixed income. I'm a little questioning if you're on a fixed income, your income didn't change when the economy got hit, and maybe they had a side job. A lot of old people have a side hustle, right? I don't know, but maybe something happened. They had that side job and they couldn't make as much income. I'm not laying any blame or fault on anybody. I'm just making some observations here. So just as a point of fact, a majority of the people who took out forbearance didn't actually need to take out the forbearance. So it's something to be aware of as you think about talking with your clients who are in forbearance. Understand a lot of people who are in it, and I think a lot of people who are in forbearance that made their May payments don't even realize they're in forbearance. They didn't realize that when they inquired about forbearance, that put them into the forbearance process. And so it's super important to help people understand when we're talking to them that, hey, if you're in forbearance, the good news is we've got a lot of options now, and I'll be spending a few minutes talking about those options this morning. All right, so I want to dive into some down payment assistance program changes. The most popular down payment assistance programs that we use are the GSFA Platinum and Open Door programs and the Cal HFA program. So GSFA changed their guidelines last month, and they raised their minimum credit score from 600 to 620, and then from 620 they jumped it all the way up to 680. That bump to 620 went, I think, in February, and then in late March, early April, they raised their credit score to 680. They used to go up to 55% of your income could be spent towards your bills and still qualify for down payment assistance. And they lowered that down to 45%, again, late March, early April. Yesterday, they announced they were relaxing their guidelines again. So they dropped the minimum credit score for down payment assistance down to 640, and they increased their debt to income ratio back up to 55%. That's really, really good news, especially with the Open Door program. This program is one of my favorite down payment assistance programs because it gives you a 2% second mortgage. So let's use some simple math here and say you're buying a $100,000 home, and FHA requires your down payment to be 3.5% down. That means that your down payment would be $3,500. And then you got closing costs on top of that. What the down payment assistance program through the Open Door says is we're going to give you 2% of your purchase price, or $2,000, in an interest-free second mortgage. And then we're going to give you additional funds as a grant. Those additional funds could be anywhere from 1% to 5% of your purchase price. So you could literally get up to 7% of your purchase price, 2% of it being an interest-free loan, the rest of it being a grant. Now you're saying, John, that's amazing. How come, grant money is being given away? Why don't we do this for everybody? Because the grant makes the interest rate on the primary mortgage more expensive, and it's incremental. So if you only take the 2% second mortgage, you get a really low interest rate on your primary loan. But if you want to get some grant money, every extra amount of grant money you get bumps up the interest rate on your primary mortgage. So just remember, whenever you see down payment assistance that talks about it being a grant program, it is not free money. It is not free money. But the Open Door program was extremely liberal in credit scores, and it was extremely liberal in debt to income ratio, and they're bringing that back. So they're bringing it back to being down to around a 640. They're bringing it back down to being up to a 55% debt to income ratio. Cal HFA has tightened their guidelines. They've lowered the debt to income ratio from 45 to 43. Couple of pieces of good news: there's no more limit on sales price, but the truth is you've got to meet income thresholds, and those income thresholds are going to stop you from going too high in purchase price. But they did raise their income limits a little bit. So as an example, in San Joaquin County, we're now up to $148,000 compared to $141. Sacramento, it's $170 compared to $165. And in the Bay Area, actually every county in the Bay Area was different. And so instead of listing them all, I honestly don't know which county I picked, but I realized afterwards they weren't, it wasn't unilateral in all Bay Area counties, but approximately 236 is the new number in at least one Bay Area county, and it was 221. Here's the deal with down payment assistance. I've explained it to you guys before, and I'm going to repeat it because it's super, super important. The two companies that manage the down payment assistance funds, which is US Bank and Gateway Mortgage. Gateway manages it for the GSFA program. US Bank manages it for Cal HFA. And they have simply said, if a buyer goes into forbearance before we sell the loan to them, and they take 45 to 60 days to buy it, then we own that loan and it has zero value on the open market. That's a huge risk a bank is taking. Now, Todd Screamer, the president of our company, has said clearly, as soon as they give the green light, that they're at least going to buy the loan and maybe just give us a reduction in our income or eliminate our profit, but at least we can still sell the loan. He's willing to open these back up. I have no specific news, but what I'll tell you is on a video last night, Todd sent out, he said that this Friday, there are going to be significant guideline changes that the field is going to be happy with. So I don't know what those are. I'm not implying it's down payment assistance. I truly have zero reason to believe that it is specifically down payment assistance. But there's only a few major things that we're still not doing, such as we are not doing renovation loans. We're not doing escrow holdbacks. We're not doing down payment assistance. That's about it. So if there's some major changes that the field is going to be super happy with, it's gotta be in one of those three categories and maybe multiple of those three categories. So stay abreast and ready for news come Friday on whatever those changes are. I'm hopeful that it will be down payment assistance. I'm hopeful that we've got some better guidelines from the down payment assistance companies and we can move forward with these. What I'll tell you is I am building a queue of clients who need down payment assistance, because if people cannot afford their own down payment, there is no point in them saying, forget it, I'm just not going to buy. Let's get them ready. So as much as I'm telling you we cannot do these loans right now, and as much as I'm telling you that I have no clue when we're going to be able to do them again, I'm also telling you, let's not let those people sit by the wayside. Let's get them in. Let's get them ready. Let's figure out if there's another way to qualify them without using down payment assistance. But if the only option is down payment assistance, I can get them ready to give a pre-approval letter as soon as we open up the programs again. All right, gang, just as a reminder, if you have questions about anything, feel free to post them into the Zoom chat. I like to keep this as interactive as I can. I do not have an hour's worth of content, so if you guys all want to get out early, don't ask any questions. Realistically, if you have questions, please post them, because that helps me make sure that I'm giving you guys the information that you need. And if you have a question, it is likely your peers have a similar question. All right, so that's it for down payment assistance programs. Again, if you have any questions on it, feel free to post into the chat. Otherwise, I'm going to go into the meat of what I wanted to cover today, which is a kind of a Q&A that was provided to us on how conventional loans are looking at a few weird dynamics that are happening right now. The first one being forbearance, the second one being SBA loans for self-employed people, and then the third one just being how we look at self-employed income overall. So I'm going to go through the Q&A that was given to us and kind of provide that to you guys so that you've got some content to give to your potential buyers. So the first question is, my credit report shows that my borrower has a mortgage in forbearance. Can I proceed with my transaction? The answer is yes, conventional only right now. So as a reminder, Fannie Mae and Freddie Mac have not given any guidance on whether they will allow for a new loan for someone who has been in forbearance. But a conventional loan, a few different scenarios, if all payments have been paid on time, in other words, if you are one of those 21% of the people in forbearance who has made their payment in May, then they just have to say, hey, I'm not gonna, basically have to say anything. They really just have to continue making their payment while we're in the refinance process. And the biggest win is the forbearance does not need to be removed from their credit report. They just plain are qualified, ignoring the fact that they were in forbearance, because we simply have proof that they've made all of their monthly payments. They can purchase a home, they can refinance just to lower their rate and their term, or they can pull cash out. So any type of loan can be done as a conventional loan if they've paid all of their monthly payments, and there's no waiting period at all. All right, so the second scenario, my borrower made a partial payment or missed a payment. Can I move forward with a new mortgage? So in this scenario, let's pretend that the client's monthly mortgage payment is $2,000 a month. And they went into forbearance in March. And on April 1st, they wanted to do the right thing and they paid $500 because that's what they could afford. That's a partial payment. Or they said, I can't afford to pay it at all, and they skipped the payment altogether. Either way, they didn't pay 100% of their payment on the month it was due. In that case, they can move forward immediately if they do what's called a reinstatement. Reinstatement simply means they contact their servicer and say, hey, I know I only paid $500 on April 1st, so I owe you the extra $1,500 there. And I know I only paid $500 on May 1st, so I owe you the extra $1,500 there. So I'm going to write you a check right now for the $3,000 that I'm short, and therefore it catches up as if you had never skipped a payment at all. The great news is they were late because they caught it up more than a month past the due dates, but we don't care. Because they were in forbearance, we don't care that there was a late payment. All we care is that they made good on it and they caught up their payments through reinstatement. So they can qualify for a new mortgage that is a conventional loan. We have to prove by the mortgage statement that there's no more arrearages or no more past due payments. But here's the cool thing. Well, actually a couple of things. Well, the cool thing I'll cover in a second. You must document that the source of funds came from a valid source if the reinstatement was done after I started the loan. Now that's hugely important. If somebody has challenges proving funds, and maybe they got money from a sister that gave them cash that they deposited into the bank to catch up on their forbearance. In that case, if they caught up on the forbearance after I started the mortgage, I can't use it. We have a problem because I can't source where the money came from to catch up the forbearance. But if they caught up the forbearance before I started my loan application, then I don't care where the money came from. I don't have to source the money. I'm simply saying that from an ease of documentation. If you are talking to somebody that is in forbearance, we do not want to get them into contract before they've caught up on their payment. Hugely important. Otherwise, we have to worry about extra documentation to prove where that money came from. And we cannot cancel and restart a loan to meet that criteria. The final piece on this is people cannot pull money out of a refinance to reinstate the mortgage loan. In other words, you got to pay to catch up your mortgage in order to take cash out of your home. You cannot use the cash out on your home to pay to catch up the mortgage. It had to be caught up before we did the mortgage. Okay, so questions on that, feel free to post into chat. Here's a situation where the borrower didn't make their payments. They went on forbearance and paid a partial or no payment at all, and they're resolving it through, and I'm going to use an industry term called a loss mitigation solution. So loss mitigation solutions, the first one is if they have a current Fannie Mae and Freddie Mac loan, they probably would have taken a deferral. And the deferral simply says whatever you owed is put at the end of the mortgage, no harm, no foul. If they have an FHA or VA loan, then they would have taken whatever they owed and made it into a second mortgage, and that second mortgage is now attached to their property, no harm, no foul. But the key is, and by the way, the third scenario is if they couldn't afford their previous payment, then they'd go on a modification, and the modification would allow them to lower their required monthly payment. Under any of those scenarios, once they start making a new payment, whether it's the same payment they had required before, or whether it's a lower payment because they went on a modification, we have to show 3 on-time payments before I can close the loan. But that's the most important part of the sentence, before I can close the loan. Technically, it's before the note date on the new loan. So I'm going to read this literally. The borrower must have made 3 consecutive on-time payments under the new payment plan as of the note date on a loan. Let me walk you through this because you'll be surprised how quickly we can get somebody pre-approved once they start making new payments. Again, the person who catches up their old payments, they can get pre-approved and buy right away. But the person who can't catch up or chooses not to catch up their old payments, that's who we're talking about right now, where they have to have 3 consecutive on-time payments under the new plan to do a conventional loan. If they need to do FHA or VA or USDA, we don't know the rules yet. So I'm super, super clear here. This is only if they're doing a conventional loan. Here's the example. Let's say they took a 3-month forbearance and they skipped April, May, and June. Well, the deferment rule says there's 1 extra month you're going to skip so that we can get you ready to start to make your new payment on August 1. So your first payment is made on August 1st. That means I can draw loan documents theoretically on October 2nd because you're going to pay August 1st, September 1st, and October 1st. I can draw the loan documents on October 2nd. Now, that's literally the soonest that I could. The truth is I'm going to need a few days to submit the proof they paid the October 1st payment, get the file cleared, get it in the docs out. So we're talking October 10th. Let's call it that. But think about that's when we're drawing loan documents. If we had a client who had, and this is assuming we can prove the October 1 payment was made. So theoretically, we could go into contract on September 1st with a 45-day escrow. So you could get a buyer into contract on September 1st, doing a 45-day escrow. They only started catching up their payments on August 1st. So they made their first payment on the plan August 1st. You can get them into contract 1 month later on September 1st on a 45-day escrow. And that gives me until October 15th to close, because by the time I'm closing, I will have proven the September, October payments were made in addition to the August payment that we already knew was made. So guys, this essentially means when somebody gets back on track to making their payments when they were in forbearance, they can literally get a pre-approval 1 month after they've made their first payment. In other words, at the time they're making their second payment, I can give them a pre-approval. You can write that 45-day escrow and we can get them closed in the month they pay their third payment. You do not have to wait 3 payments before we issue a pre-approval letter. Hopefully that makes sense to me. When I reread these rules and really dove in, that was a huge win, because that significantly shortens the amount of time that literally the 1/3 of consumers who are in forbearance, that actually 2/3 of consumers, 79%, that's a little more than 2/3. 79% of the people who are in forbearance didn't make their May payment. So you've got a bunch of people that either have to catch up the payments they missed, or they have to resolve it and start making payments again. But as Kathleen said, yes, it's crazy, but it's great news. We're not, basically, the government's walked a really fine line here. I've got mixed emotions about it, but the truth is they made their bed and now they're lying in it, and they're basically saying, look, we gave everybody a free pass to get in, we might as well get them a free pass to get out. And that's what they've done. And so I think that that's the best solution we could have asked for the challenging circumstances that they created by how quickly they wrote the rules in the CARES Act. All right, just to be clear, in this situation, Let me make sure I know what I'm thinking here. The proceeds of a cash out refinance can be used. Oh, okay, so when someone is in a modification, or let me rephrase that. They skip 3 months of payments, and they've now made 3 on-time payments. They still have those 3 months of payments that they've skipped that have been tacked on at the end. When we refinance, we're paying off those 3 months of payments. So in other words, through that new loan, they're catching up, and they don't have that balloon of 3 to 12 payments due at the end. That's what this was referring to. All right, guys, again, feel free to post into chat any questions you have. So I'm going to cover some other things that have come up on Q&As that realtors have been asking, that I've been asking, that I got clarification on. So let's think big picture here. People aren't just getting deferments on their mortgage. People are getting deferments on their car loans, on their student loans, on their credit cards, because there's been a major economic event that's caused a huge amount of unemployment. So the question I've gotten fairly often is, hey, wait a second, I don't have to count that car payment because I'm in deferment or I'm in forbearance on that car payment. Well, that's not how we look at it. So we have to count whatever the monthly payment is, even if it is temporarily suspended due to COVID-19. So if you've got a situation, and I've had some clients where they're saying, hey, my income has dropped, but so have my debts. Well, yeah, but the problem is that the drop in your debts is temporary. And their response is, well, sure, but the drop in my income is temporary. Well, we're always going to take the worst case scenario approach. We're going to treat the drop in your income as if it could be permanent, and we're going to treat the drop in your expenses as if they are temporary and will continue. And unfortunately, or maybe fortunately, we hold the money, we get to make all the rules. That's kind of what I really want to say to the clients that get mad at me. How dare you think that? Well, if you had $500,000 of your own money, you wouldn't need me. But I can't say that to them. So I can say that to you guys, though. All right, so they do have to we do have to count the monthly payments, even if they've deferred any other debts. SBA is a big challenge right now. And the truth is, the SBA loans are very much like the deferment forbearance issue where, hey, everybody said, go get a forbearance on your mortgage just for precautionary reasons. And they said, go get an SBA loan just for precautionary reasons. And it's causing challenges. So let me explain to you in more detail what those challenges are. So the question is, my credit report shows an inquiry from the SBA, what's required? Well, we've got to provide documentation showing what type of loan that they applied for, and if the loan is still in process, we're dead in the water until the loan is withdrawn or until we get confirmation of the terms on the loan. I don't care what type of SBA loan that you are doing. We cannot, now specifically, we're concerned about the EIDL. I'll explain that in a moment, the EIDG, and the PPP. So if you are doing one of those SBA loans or your borrower is doing one of those SBA loans, and I had a client last night that was doing that, and I actually gave them a pre-approval letter this morning to the agent that's actually on this call right now, and they are in the middle of doing an SBA loan. And I told them, stop that. And they said, no problem. And so they're withdrawing their application because they didn't really need the money. They just thought, hey, what's the big deal? I might as well do it. As a matter of fact, theirs was a step worse, not worse in a confusing way as far as what their understanding was, and I'll cover it in a second. But the first question I want to give you the answer to is, if somebody's in the middle of an SBA loan and they are in process, we're stuck. We have to have them cancel the process, or we have to wait until it's approved and we have the terms. Now, what about specifically on the PPP loan? So the PPP loan is the Paycheck Protection Program. And the PPP loan is a forgivable loan provided you meet their criteria. And here's where I'm still a little confused because the Q&A didn't give me enough A. It actually gave me some extra Q. Because what we're saying is I don't have to count the payment on the PPP loan unless we determine that any portion of it must be repaid, and then I have to count that payment. But how are we going to determine if it has to get repaid? Like my best guess is right now, we would have to assume that it's all going to be forgiven because we have no proof that you aren't spending the money the right way. But when it comes time to reconcile and determine whether or not you have to pay it back, if we have confirmation that, hey, only half your PPP money was forgiven, the other half of the money you have to pay back, then I do have to count that towards your debt to income ratio. Here's the second challenge. I need to know why you applied for it. because technically any of these loans are designed for people who are have been impacted by COVID-19 and the economic shutdown. Well, if you've been impacted by COVID-19 and you're applying for a loan to help offset that impact, then that means I don't know that I can trust the income that you've earned in the past to be stable in the current times. And that creates a big cloud of question marks in the eyes of underwriting. Also, we definitely need to look at the most recent 30 days of business bank statements to prove that there hasn't been a significant impact to your business activity, because that's, again, a serious concern on our part when somebody's applied for a loan that's designed to help you out in tough times. So now let's talk about the EIDL. So first of all, the EIDL is the Economic Injury Disaster Loan. So right up here, Economic Injury Disaster Loan. Good news, I used to call it the Economic Something Disaster Loan because I couldn't remember what the I stood for. Now I know, it's injury. All right, so it's the Economic Injury Disaster Loan. That is the one you apply for directly with SBA. You go to sba.gov/disaster and you apply for it. To qualify for it, you have to have suffered substantial economic injury. Read the words. You have to have suffered substantial economic injury, and it is not forgiven. And so the confusion, this is what my client last night was confused about, is that the CARES Act allows for up to a $10,000 advance that's paid within 3 days of applying for the SBA EIDL. So the grants, you don't apply for the grants. You apply for the loan, and as part of the loan process, you can get up to a $10,000 advance on your loan that does not have to be repaid. Therefore, it's called the grant. My client last night, I saw the inquiry from the SBA on their credit report, and I said, hey, tell me about this. And they said, well, we applied for the grant. And I said, okay, are you aware that you applied for the loan? Nope, we didn't apply for the loan. And this is when I have to step back and say I'm not an expert in this stuff, but people who are experts have advised me that when you apply for the grants, you actually applied for the loan. The grant is just step one in the loan application processing process. And so they were unaware of that fact, and I made it clear to them, you technically have a loan application in process with them. And if you choose to continue that loan application, I cannot pre-approve you for this loan, because I can't pre-approve you until I know how much they're loaning you, what the terms are, and then I just have to make sure you can afford the payment. And as long as you do, we're fine. But until it's approved, I cannot move forward at all. And that's the thing that most people misunderstand. Just like my client last night, they thought they were applying for the SBA grant. They did, but they were actually applying for the loan. Stage one of the loan is the grant money, and then they're processing the loan. This money is not forgivable. And so if we have a client and it shows that they applied for the EIDL, I have to have the loan agreement. So this is SBA's terminology. The loan authorization and agreement is the form that comes from SBA, and I have to count those payments. No big deal as long as you can afford it. The issue is how long it's taking to get approved. I have no knowledge of how long it's taking to get people approved right now. So I can't tell you that, hey, somebody who applied 3 weeks ago, they're almost ready to be approved. It's no big deal. I don't know. But what I can tell you is if they're in process, we cannot move forward until we get documentation from the SBA that the loan was approved or that it was denied or withdrawn. And it has to come from SBA. Like my client last night can't write me a letter saying, hey, John, I withdrew my application from the SBA. That's not good enough. They have to withdraw the application. I have to get proof from SBA that the application was withdrawn. All right, guys, again, if you have questions about any of this, feel free to post it in chats. I'm going to move on now to some income questions that keep coming up. So furlough is another F word, kind of like forbearance. We got the furlough F word. And furlough, we all understand, hey, I've been furloughed. You know, your job's not available for you right now. Your employer does not have enough business to keep you employed and keep you on payroll. And so you're unemployed, but kind of it's a minor difference in the fact that your employer expects to have a job for you to come back to. But let's say you're furloughed and your employer is still paying you during that time. That's not okay. I can't use that income because your employer has specifically said, look, I know business has dropped enough that I don't need you, but I can't help you or I can't employ you, but I'm going to pay you for a short period of time. The problem is that income is not known to continue into the future. As a matter of fact, it's known that that furlough income is likely going to end at some point. So we cannot use it because it is not stable, predictable, or likely to continue. And just for the record, likely to continue, we're typically looking for something likely to continue for at least 3 years. So if you have income, let's say you have a note that you're receiving payments on, and you're getting payments for the next 4 years, that's perfect. If you're getting payments for the next 2.5 years, I cannot use it. Now call me crazy because these are 30-year mortgages I'm giving out and all we care about is that you have enough income to cover the first 3. I'm not sure how you're going to pay for the other 27, but I know the guidelines say as long as the income's going to last for at least 3 years from the date that we do the loan, then you're fine. I can count the income. I guess the assumption is after 3 years, you'll figure it out. You'll sell the house. I don't really know. I try super, super hard to thoroughly understand all of the reasons why my industry does what we do. This is one that I kind of have a hard time with. Maybe it's just our best guess to say, hey, we can't be overly conservative and prove that the payment's going to last for a full 30 years. So we had to pick a date in the future that says, well, if it's at least going to last 3 years, then we have to hope that they're going to find a way to make the payment after that. I don't really know. But I digress. I got a little sidetracked there. So continuing on income requirements, my borrower is getting unemployment. Like, gosh, there are a lot of people making more money in unemployment right now than what they were making on their job. There's some part-time workers that I know who are making, with the extra $600 a week plus their base unemployment benefits, are making more money right now than what they made when they were on their job. And so they're saying, hey, can I qualify for a mortgage? And this is a super long answer, but really all you need to do is read the first 2 letters. No. No, no, no. Now, this goes into a little bit more detail. You can buy a home if you're on unemployment. If it's seasonal unemployment, and if the last 2 years of taxes show that you worked and were paid unemployment each of those years. A couple of examples of that would be farm workers. Maybe you've got a construction, maybe somebody who works, a laborer who works in an industry that can only work during good weather. And so maybe, January, February of normal years when there's a lot of rain, they don't work. And so every year they're off work during that time frame, every year they get unemployment. Then I don't care if they're on the job or not. I don't care if they're in their seasonal unemployment period or their seasonal employment period. I can qualify that person even when they're earning unemployment. But someone who is not regularly receiving unemployment for the last 2 years cannot count their unemployment income they're making today, even if it's more than what they're making on their regular job. Now there is I'm going to go on a tangent again. There is a circumstance if someone is on short-term disability, specifically FMLA, where we can use the income that they're getting on the short-term disability because they're out for FMLA. And there's some weird rules, I won't go into all the details, that basically say, hey, if your FMLA income is less than what your normal income is, as long as you have extra money in savings to make up that difference until you go back to work, then we're perfectly fine qualifying you using your normal income. So just be aware, if you've got somebody who is on disability FMLA, that's not unemployment, but that is out for Family Medical Leave Act, they can qualify, and if they have enough extra reserves, they can qualify without having to worry about the lower income they're making while out on FMLA. All right, hopefully that helps on that one. The next thing I'm going to cover, and really this is my last slide that is going to talk about guideline Q&A, is self-employment documentation. This has become the bane of my existence. I told you guys a month or 2 ago, it's really my biggest worry, and I'm still worried about how Fannie Mae and Freddie Mac are going to treat self-employed people or people earning commission and overtime and bonuses for the next 2 years. How are we going to treat these people? Because right now we're in the middle of the problem, and the current issue is, has their income dropped due to COVID-19 and the economic challenges that we're dealing with? And I got to have all of this stuff in order to prove it. I'm not going to read it to you. Y'all can read. I got to have all of this stuff to prove that their income has not dropped. The bigger question for me is, okay, your income dropped. You don't qualify for a mortgage today, but now you're back to work. Let's say you're a barber, because I understand barbers are going back to work. I like my homegrown haircut now, so I might keep with this. It's much less expensive, and I love the barber. So anyway, literally. But let's say you're a barber. You want to qualify for a mortgage right now. You're not going to qualify because your income has been significantly curtailed, if not completely eliminated. But hey, in a week or so, you're allowed to go back to work. That's awesome. So now that you're back to work, how do I treat the 3 months you were off? How do I average your income? Because I don't have new tax returns. I won't have those new tax returns until next year. So do I have to look at, hey, how much did you make so far this year? Because half of this year you were shut down. Do I have to prove, like right now we're talking about, hey, we want to know the most recent 30-day transaction history. So does that mean in August, I only care about what they made in July? And as long as their income in July is on par with what their income was in 2019, I'm good? Maybe. Can you see the challenges and the questions here? Because clearly their income's not going to be the same for the whole year. Now what happens in 2021? When that person files their tax return for 2020, and it shows that instead of having $50,000 in profit, they had $30,000 in profit because they were off for a large portion of time. And it took a little bit of time to rebuild that income. Well, now what qualification am I using? Because I could show that for the last 10 years, they made 50 grand every year, but in 2020, they only made 30 grand. So do I use the 30? Or do I use the 50 and show that, hey, if we averaged it out and took out those few months they were closed, they're still on track to make 50 every year? I don't know. That's my biggest concern going forward. The same holds true for commissioned people. The same holds true for people who make overtime or bonuses, because all of that income is going to be curtailed simply because of the shelter in place and the economic challenges we've been dealing with. So these are the questions I'm hoping to get answers to and help provide you guys these answers as we go forward and continue to provide these weekly updates. So at this point, I've covered everything I want to cover as far as big picture stuff. I want to remind you about my webinars. I'm continuing to do them every Thursday night. So we are going to do one tomorrow night, and it's going to be how to buy your first home in 2020. So this one's a really good one. I did one about 6 weeks ago, got great feedback on it. People loved it. And it's really, really good to be there live because you get to ask your questions and get clarification. So if you've got anybody who's thinking about buying their first home this year, and I know that every single one of you have at least 3 somebodies that you know are thinking about buying their first home this year, you must immediately email them, Facebook message them, text them, and Telegram them with this website, www.rsvpwithjohn.com. Better yet, go on there, register them on their behalf, and then send them a text telling them they need to be there tomorrow night, 5:30 on Zoom. It's going to be great. You definitely don't want to miss it. Next week, I'm going to do my 6 steps to financial freedom because I feel responsible for getting people into the biggest debt they've ever been in their life, and therefore I want to help them get out of that debt as quickly as possible. So we're going to talk about steps to help gain financial freedom. And then on Thursday, the 11th, we are going to be going over understanding credit scores. A lot of misunderstandings out there, even people who have great credit. There's good information for you. People who have challenged credit or don't understand why they can't get the credit score up, it is going to be a really, really good webinar. So make sure all of these webinars you'll be able to get to by clicking on rsvpwithjohn.com. The final webinar that I want to invite you guys to is one that I'm doing this Friday. It is Mortgage 101. I will tell you it is specifically designed for new real estate agents, but it is going to be a good refresher course for anyone who feels they would like it. So it's going to cover the difference between Fannie Mae, Freddie Mac, FHA, and VA. It's going to talk about appraisals and what lenders look for in appraisals. We're going to talk about a lot of things, down payment requirements, where the money can come from. Again, a lot of really, really basic things. But as you're out there talking to buyers about qualifying for a home loan, you need to be armed with some basic information. I'm going to be providing that information on Friday morning of this week. So 2 days from now, in 47 hours and 16 minutes, you can join me on Zoom, and I will be, got quick math, right? Calculus, no, but quick math like that, I got it. So 47 hours, 16 minutes, I'm going to be providing that information at 11 a.m., Kathleen, 11 a.m. on Friday morning. So go to RSVP with John, click on, I don't know what I called it, Realtor webinars or industry partner webinars. That will give you the link to the one on Friday. If you go to the same website and you click on consumer webinars, you get the link to all 3 of these. So register for the one coming up on Friday for yourself, register for tomorrow night's How to Buy Your First Home for yourself, and for everybody that you know who's thinking about buying a home this year. Super, super good information. All of these can be found by going to RSVP with John. I also want to take a quick moment and reintroduce my special guest that joins me every week, just to make sure in case we have any questions regarding title. One of the best title guys that I know, Jeff Lee. Jeff, take a minute and introduce yourself, and thanks for coming.
Thanks for continually inviting me. No new updates other than the San Joaquin Superior Court is kind of officially open on the 28th. I've been doing this since 1993. So I'm old school. If you have any questions, feel free to call me on my cell phone, 209-915-HELP. Thanks, Sean.
1993, I think that was like the year after I was born. Oh, I wish.
That's
all right, anyway.
Yeah.
All right, gang. If you don't have any other questions, I really appreciate it. Please help me spread the word about these webinars. Hope everybody's having a great week, and look for that amazing new information I release on Friday. I have no idea what it's going to be, and I'll look like a fool if we don't actually announce anything cool, but I'm hopeful and confident we will. He gave us some heads up last week before he announced the release of the relaxation of the cash out refinance guidelines. And so I wholly expect that there's going to be some good information. And again, I feel pretty strong it's going to have to do with one of the 3 categories, either renovation loans, down payment assistance loans, or escrow holdbacks. Those are the 3 big things that I can think of that we still have pretty severe restrictions. Have a great week, guys. We'll talk to you soon. Call me if you need anything. Bye.